So some folks are saying that the Fed is going to drop the rate. The others are saying they're going to raise the rate. So I'll share with you two of my favorite YouTubers' key points. They're really smart people, and I watched their video and I'll give you the summary of their points so you don't have to watch their 20-minute videos. And then I'll give you one tip or two to protect yourself either direction. Whether the Fed is going to raise or lower the rate, it doesn't matter. You're going to be protected when it comes to house purchasing. Welcome back to Shawn Realty podcast. So Peter Zeihan, he's more like a geopolitical kind of guy, big picture kind of guy. When it comes to the international dynamics, I think he's really, really smart. Now, Brian Kim is more like a CPA kind of guy, economics, sort of the housing market data, the Fed funds rate. So he's more of economic side. Now, Peter Zeihan thinks that the Fed is going to raise the Fed funds rate. And if you're going to borrow money, borrow now. He's saying 5.5% is going to be the lowest for the next 2 to 5 years, maybe a decade. Brian Kim says he disagrees with Peter and he thinks that rate's going to come down within the next 2 years, actually. So let's kind of dive into what their main key points, main reasoning why they're saying what they say. And then I'll go into my protection mode for you guys. So Peter thinks that in the next 2 to 5 years, because of what the Fed's preferred measure of the inflation is called personal consumption expenditure index, which I actually didn't know that kind of thing existed, but he's basing on that. And he basically pointed out Wall Street predicting wrong about the last winter and beginning of this year. The Fed was going to drop the rate. That didn't happen. And one of the main key points that he believes the rate's going to go up is because new normal of the inflation, the Fed's target 2% is not going to happen. The second part is the boomers' money is exiting the Wall Street market. And because of that, there's less capital-rich environment, and then they'll have to come up with different system to fulfill that, the less capital-rich environment. But at the same time, he talks about higher demand. In my opinion, when the money is out, where does that money go? So I'm just thinking about baby boomers' money. If they pull out the stock market, they're going to maybe fund their retirement, buying groceries and things like that. Maybe that's what he means. So the demand is going to go up. So inflation is going to still stay up because money is pulling into the market. Maybe that's what he means. Based on that, he believes that if you're going to borrow, you need to borrow now because he doesn't see how Fed can reduce the Fed funds rate unless they change the goalpost higher than 2%. The opposition, Brian thinks that there will be a period lower than now. The rate will be lower than now, is coming sometime soon. He believes that Fed will not wait 2 to 5 years to cut the rate. And likely their next move will be cutting the rate. That's what he thinks. And he points out that the Fed's goal is to bring down Fed funds rate to 5.5% to 2.75% is their goal, but they have to meet the dual mandate, which is basically helping out the unemployment, and employment, and managing the inflation. So when the unemployment rate goes to 4% or higher, he thinks that Fed is going to jump in and cut the rate to help out the economy. That will boost the employment. And he believes that when something breaks, Fed is again going to jump in and help out. But he basically says the United States cannot afford to go into recession. And for example, he gave all the like labor, residential housing, stock market, economy, or commercial real estate, or banks. If some of these will break, then it will go into a recession, he thinks, and that's what they're trying to prevent. And he believes that the Fed will come in and help out by cutting the rate. I don't know what you guys think. I'm not an economist. I'm not really sure what will happen, but going into protect mode, if the rate goes to 8%, or if the rate goes to 6%, if you follow my tips, you should be you should be protected one way or the other. When I think about saving money advice on housing market, I try to look at all the different investment asset classes and try to learn how they position themselves. So for example, the people who invest in stock market, they call it the dollar cost averaging, meaning they just put in certain amount every month, whether the market is going up or down. In real estate, unfortunately, we can buy a garage one month and then buy a bathroom next month. We cannot do that. So in my opinion, the DCA of real estate is really staying in the market. When you're looking for a home, just don't go into sideline and watch for next 3 years, because that's when you're going to regret. And if you think about it, in 2015, 16, 17, 18, 19, 20, 21, 22, no buyer said that I should have waited. I should have waited to buy. Nobody says that, because they had the great interest rate. The price was high, but they're all saying that I got lucky getting 3% interest rate. My question to you is that, what if you're gonna look back next year, if the Peter Zeihan is right, rate could be at 8%. And you could be saying, oh, if you bought it now, I'm so glad I bought it at 7%, not 8.5%. If you're going to, let's say, stay in the game and you can afford at 7%, and you found a property that will serve you well in the next 5 to 7 years, my recommendation is just go ahead and buy it. Because if the rate goes to 8%, you're going to say, oh wow, I'm so glad that I bought at 7%. And more likely the home price will go up at that point, even at 8%. But what if the rate goes to 6%? You bought it at 7%. What you can do is just go ahead and refinance that home. So if you buy now at 7%, no matter where it goes, you're going to win, and you're going to win because you own a property now. And the 30-year rate is locked. The bank cannot change that rate. Like I said, hopefully the rate will go down to 6%-ish so that you don't have to compete with the other buyers at the time. You already own the property, you've been living in there, saving the rent money and everything. You're just set for the next so many years. If it goes to 8, you'll be thanking me, because by then the price will be even probably higher, and you have to pay another 1%. That affects about 11% of the buying power. So you would have lost about 11% of buying power. Means that with the same monthly payment, you can afford cheaper home, less expensive home. You can buy as much. So that's what I wanted to share. One last thing is that just stick to 30 years, because this is a situation that I'm worried. If you get a variable mortgage rate, if that happens, you're going to freak out. If it's like a 5-year ARM, ARM means adjustable rate mortgage. Let me write it down for you. So ARM, when you see ARM, I would be really careful. You're basically gambling at that point. In 5-year ARM is in 5 years, you are at the mercy of the interest rate and Fed funds rate. Let's hope that Brian is right. Rate going down, that's better for us, better for buyers, better for consumers. The borrowing money is so expensive right now, so it needs to go down for sure. But if Peter is right, at least you're going to be protected by buying now at 30-year loan. Let me write it down because it's important. 30-year loan, hope you can see. Just stick to this, don't do ARM. Let's hope for this and not hope for that. But either way, you're going to be protected, either direction. So I hope that helps. If you enjoyed it, please hit the like button and subscribe and share it with your friends, family member, your kids who need to buy. If you buy in Alabama, I don't get a dime, but I hope that you got some good timely information to help you out to save some money. So, this was Shawn the Realtor, not Shawn the Sheep, giving you other homeownership tips. Thanks for watching. Thank you for your support. and I'll see you on the next video.